Short-selling firms, Hindenburg Research, History, Present and Future. Introduction.
Hindenburg Research, founded in 2017 by Nathan Anderson, is a New York-based financial research firm that has gained notoriety for its investigative reports exposing corporate misconduct, fraud, and financial irregularities. Utilizing a short-selling strategy, Hindenburg seeks to uncover unethical practices within publicly traded companies, thus promoting market transparency and accountability. This report delves into the history, research methodology, significant impacts, controversies, and future outlook of Hindenburg Research. History of Hindenburg Research. Founding and mission. Hindenburg Research was established with a clear mission: to provide critical insights into corporate malfeasance and to promote accountability within the financial markets. The firm's name derives from the infamous Hindenburg disaster of 1937, which Anderson likens to the preventable crises that can occur in financial markets due to corporate greed and unethical practices. Since its inception, Hindenburg has targeted a variety of sectors, including technology, healthcare, and renewable energy, thereby broadening the scope of its investigative reach. The firm has positioned itself as a forensic financial research entity, combining thorough investigation with a desire to inform the public and regulators about potential financial dangers.
Notable investigations.
Hindenburg Research has garnered attention for its high-profile investigations.
Some of the most notable include: Adani Group 2023, Hindenburg conducted an extensive investigation into the Indian conglomerate, revealing a long-standing scheme involving stock manipulation and accounting fraud. The report led to a staggering $34 billion loss in market value for the Adani Group within a week, prompting regulatory scrutiny and legal challenges. Nikola Corporation 2020, the firm questioned the legitimacy of Nikola's claims concerning its electric vehicles, leading to significant stock price drops and investigations by both the SEC and the Department of Justice. Over the years, Hindenburg has targeted 16 large-scale businesses, which has resulted in 63 individuals being charged with fraud-related activities by the SEC following the firm's disclosures. Research methodology.
Hindenburg Research employs a rigorous and meticulous approach to its investigations.
The firm's methodology includes:
1. Public records analysis. Hindenburg utilizes publicly available documents such as financial reports, regulatory filings, and media articles to gather relevant information about the companies under scrutiny. 2. Whistleblower tips. The firm often relies on tips from whistleblowers who provide insider information regarding corporate malfeasance.
3. Financial analysis. Hindenburg conducts deep financial analyses to identify discrepancies in a company's reported figures and operational practices. 4. A publication of findings. After completing its investigations, Hindenburg publishes detailed reports outlining its findings, often accompanied by a short-selling position to capitalize on the market reaction. Short-selling strategy. Short-selling is a critical component of Hindenburg's operational strategy.
By betting against companies that it believes are overvalued or engaging in fraudulent practices, Hindenburg profits from the decline in stock prices post-investigation. This dual role as both investigator and short seller has drawn both praise and criticism, leading to discussions about the ethical implications of such practices.
Impact and market response. The impact of Hindenburg's reports is significant and immediate.
On average, companies targeted by Hindenburg experience a stock price decline of approximately 15% following the publication of an investigation. This immediate effect underscores the power of Hindenburg's research in shaping market perceptions and investor behavior. Despite criticisms from some quarters that accuse short sellers of artificially depressing stock prices, Hindenburg maintains that its reports serve a greater purpose: exposing unethical behavior and promoting market integrity. The firm's work has resulted in numerous regulatory investigations and has contributed to a broader cultural shift toward transparency and accountability in the corporate landscape.
Controversies and criticisms.
Hindenburg Research has not been without controversies. Critics argue that the firm's short-selling tactics can lead to market manipulation, suggesting that the act of shorting stocks when combined with negative publicity creates a self-fulfilling prophecy of declining stock prices.
Some companies have also challenged Hindenburg's findings, alleging that the reports are misleading or unfounded. Legal battles have ensued, with Hindenburg successfully defending its investigative practices in many instances. The firm's transparency in disclosing its research methods and findings helps to bolster its credibility even amid criticisms. Future outlook. Looking ahead,
Hindenburg Research is poised to continue its mission of uncovering corporate fraud and promoting market integrity. As the financial landscape evolves, the firm may face increased regulatory scrutiny and legal challenges. However, its reputation as a leading investigative entity in the finance sector is likely to endure. The growing emphasis on corporate responsibility and ethical practices may provide Hindenburg with additional opportunities to engage in impactful research. As investors become more conscious of the ethical implications of their investments, firms like Hindenburg that prioritize transparency may find themselves increasingly relevant.
Conclusion.
Hindenburg Research has emerged as a formidable force in the realm of financial investigations, driven by a commitment to uncovering corporate fraud and ensuring market accountability. Through its rigorous methodology and impactful reports, the firm has reshaped the discourse surrounding corporate ethics and investor awareness. As it navigates the complexities of the financial landscape,
Hindenburg Research will continue to play a pivotal role in promoting transparency and accountability, cementing its legacy as a key player in the modern finance industry.
Hindenburg Research, a New York-based financial research firm founded by Nathan Anderson in 2017, is primarily known for its short-selling strategies and investigative reports that expose corporate misconduct. The firm aims to promote market transparency by uncovering unethical practices and fraud using methods that blend forensic financial analysis with public records and whistleblower tips. This approach has led to significant financial implications for the companies targeted in their reports, which often result in stock price declines.
One of the notable counterintuitive aspects of Hindenburg's operations is the perception of short selling as inherently harmful to companies.
Critics argue that short sellers like Hindenburg manipulate stock prices downward, potentially harming innocent investors.
However, Hindenburg contends that their reports reveal genuine risks posed by corporate malfeasance, which ultimately serves the greater good by correcting market inefficiencies. This perspective positions Hindenburg not merely as profit-driven short sellers but as watchdogs that hold corporations accountable, fostering a healthier market environment. The firm has garnered attention for its investigations across various sectors, including technology, healthcare, and renewable energy, with a particularly impactful report on India's Adani Group, which exposed long-standing financial irregularities and resulted in a massive loss of wealth for the company. This case exemplifies the dual nature of Hindenburg's influence. While it can lead to immediate financial repercussions for the companies involved, it also compels a re-evaluation of corporate governance practices and investor vigilance. Another counterintuitive element is the notion that Hindenburg's activities might encourage better business practices.
While the immediate effect of a Hindenburg report is often a sharp decline in stock price, the long-term implications may drive companies to adopt more transparent and ethical practices to avoid similar scrutiny in the future. This potential for positive change stands in stark contrast to the traditional view of short selling as a purely destructive force in the market. Furthermore, the firm's approach challenges the conventional wisdom regarding investment risk. Instead of solely focusing on market trends and financial metrics, Hindenburg emphasizes the importance of ethical conduct and corporate governance.
This shift in focus may lead investors to reconsider their strategies, highlighting the value of investing in companies that prioritize transparency and accountability.
Hindenburg Research's impact on the market also raises ethical questions surrounding the balance between exposing wrongdoing and the potential for market manipulation. While the firm argues that its reports are based on solid evidence and aimed at protecting investors, the timing and nature of short selling can create a perception of opportunism. This dichotomy invites ongoing debate about the role of short sellers in financial markets and the ethical implications of their strategies. Looking to the future, Hindenburg is likely to face increased scrutiny and potential legal challenges as its influence grows. As it continues to expose corporate wrongdoing, the firm may encounter pushback from targeted companies and their stakeholders who may view Hindenburg's actions as threats to their financial stability and reputations. However, the firm's track record suggests a commitment to rigorous investigative standards, which could help it withstand legal challenges and maintain its credibility. In summary, Hindenburg Research serves as a complex entity within the financial landscape. While its short-selling activities can lead to immediate financial consequences for companies, the underlying mission to promote transparency and accountability offers a counterintuitive view of the role of short sellers. By challenging traditional notions of investment risk and corporate ethics, Hindenburg may ultimately contribute to a more robust and responsible market. As the firm navigates its future, its ability to balance profit motives with a commitment to ethical practices will be crucial in shaping its legacy in the world of financial research and corporate accountability. Hindenburg Research, a prominent financial research firm founded by Nathan Anderson in 2017, has garnered attention for its investigative reports that expose corporate fraud and unethical practices. The company employs a short-selling strategy, meaning it profits from the decline in stock prices of the companies it targets after revealing their malpractices. While the firm is recognized for its forensic financial investigations, some significant aspects of its operation and impact are often overlooked, yet they are crucial for understanding its broader implications in the financial world. 1. The ethical dimension of short selling. One important aspect often overlooked is the ethical implications of Hindenburg's short-selling strategy. Critics argue that short-selling can create a hostile market atmosphere, leading to stock price manipulation and undermining investor confidence. However, Hindenburg's approach challenges this narrative. By exposing fraudulent activities, the firm aims to protect investors and promote market integrity. This dual role as both a short seller and a whistleblower raises critical questions about the ethics of profit-making at the expense of companies engaged in misconduct. Understanding this ethical dilemma can prompt a deeper conversation about the responsibilities of financial analysts and researchers in maintaining market transparency. 2. The role of whistleblowers. Hindenburg Research often relies on whistleblower tips to gather information about corporate wrongdoing. The significance of this reliance is profound, as it highlights the importance of whistleblower protections in the financial industry. Many individuals within companies may be aware of unethical practices but fear retaliation for coming forward. Hindenburg's success in exposing fraud relies on these brave individuals willing to risk their careers for the greater good. This aspect underscores the necessity for stronger legal frameworks to protect whistleblowers, as their contributions are vital for maintaining accountability in corporate governance. 3. The impact on market psychology. The immediate market reactions following Hindenburg's reports are notable, as they often result in substantial stock price declines. This phenomenon is significant not only for investors but also for understanding market psychology. When a well-respected firm like Hindenburg releases a damaging report, it can trigger a panic among investors, leading to a sell-off that may not necessarily reflect the company's fundamentals but rather the fear induced by the report. This aspect of market behavior raises questions about the emotional responses of investors and the potential for irrational decision-making in the face of negative news, which can amplify the effects of Hindenburg's findings. 4. Legal challenges and their implications. Hindenburg has faced numerous legal challenges from companies disputing its findings, which is another detail often glossed over. These legal battles not only test the validity of Hindenburg's claims but also highlight the broader implications for freedom of speech and journalistic integrity in financial reporting. The outcomes of these cases can set precedents that affect how financial research firms operate and the extent to which they can investigate and report on corporate misconduct. This dynamic raises critical questions about the balance between corporate interests and the public's right to know, emphasizing the need for a robust legal framework that supports investigative journalism in finance. 5. The broader implications for corporate governance.
Hindenburg's investigations often lead to broader discussions about corporate governance and accountability.
The firm's reports not only expose individual companies but also foster a culture of scrutiny that can deter future misconduct across industries.
This ripple effect is significant,
as it encourages companies to adopt better governance practices and enhance transparency to avoid becoming targets of similar investigations. Recognizing this systemic impact is essential for understanding Hindenburg's role in shaping corporate behavior and promoting ethical standards within the business community.
6. The evolution of Hindenburg Research.
Since its inception, Hindenburg has evolved from a relatively obscure player in the financial research landscape to a formidable force known for its impactful reports. This transformation raises important questions about the evolving nature of financial analysis and the increasing demand for transparency in corporate practices. As investors become more aware of the risks associated with unethical behavior, the role of firms like Hindenburg may grow in importance, potentially leading to a shift in how financial research is conducted and valued. 7. The global reach and impact. Hindenburg's investigations are not limited to U.S. companies. Its scope has expanded globally,
as seen in its notable report on India's Adani Group. This international focus is significant because it reflects a growing trend of cross-border accountability in corporate governance.
The implications of Hindenburg's work extend beyond national boundaries, highlighting the interconnectedness of global markets and the need for international standards in corporate ethics. Understanding this global perspective can help stakeholders navigate the complexities of international finance and corporate responsibility. 8. The future of financial research. Looking ahead, the future of financial research may be heavily influenced by the practices established by Hindenburg Research. As regulatory environments evolve and investor expectations shift toward greater accountability, firms that prioritize transparency and ethical practices may gain advantages in the marketplace. The significance of Hindenburg's methodology centered on thorough investigative work and a commitment to exposing wrongdoing
could pave the way for a new era of financial analysis that values integrity over mere profitability. Conclusion.
In summary, Hindenburg Research represents a significant force in the financial landscape, yet its impact extends far beyond short-selling and corporate investigations. The ethical implications of its strategies, the crucial role of whistleblowers, the psychological effects on market behavior, and the broader implications for corporate governance are all vital elements that deserve more attention. As the firm continues to evolve and challenge corporate misconduct globally, its influence on financial research and market integrity will likely grow, shaping the future of how investors and companies interact in an increasingly transparent marketplace. Understanding these overlooked aspects is crucial for investors, regulators, and corporate leaders alike as they navigate the complexities of modern finance. 1. Historical context and mission. Hindenburg Research, founded by Nathan Anderson in 2017, has positioned itself as a key player in the realm of financial investigations, specifically targeting corporate misconduct and fraud. The firm takes its name from the Hindenburg disaster, symbolizing the man-made financial disasters it seeks to expose. Its mission is to enhance market transparency and accountability by revealing unethical practices that might harm investors and consumers. This historical context underscores the firm's commitment to ethical standards and the importance of its investigative work within the financial landscape. 2. Research methodology. Hindenburg Research employs a rigorous methodological approach combining public records analysis, whistleblower tips, and detailed financial evaluations. This forensic financial research ensures that its reports are grounded in factual evidence, thereby maintaining credibility in the eyes of investors and regulators. The firm's ability to conduct thorough investigations has led to significant findings such as its high-profile case against India's Adani Group, which revealed extensive fraud and manipulation. This methodology not only highlights the firm's investigative prowess but also raises discussions about the ethical implications of short-selling in relation to its findings. 3. Impact on market dynamics. The reports produced by Hindenburg Research typically lead to immediate and substantial declines in the stock prices of the targeted companies, averaging around 15% following a report's release. This impact reflects the powerful role that such investigative firms can play in the financial markets. While some critics argue that short-selling strategies can artificially depress stock prices, proponents argue that Hindenburg's work exposes underlying corporate malfeasance, thereby fostering a healthier market environment. The resulting legal consequences for those implicated further emphasize the significance of Hindenburg's role in promoting accountability. 4. Future prospects and challenges. As Hindenburg Research continues to unearth corporate fraud, it faces potential legal challenges and growing scrutiny from the companies it investigates. The backlash from targeted firms raises questions about the sustainability of its business model and its long-term influence on market transparency. However, the demand for accountability and ethical conduct in corporate governance suggests that Hindenburg will remain a critical watchdog in the financial industry. Its ongoing efforts could lead to broader regulatory changes and a shift in public perception regarding the importance of transparency in corporate practices. Here are 3 famous historical cases related to short-selling firms and their impact on financial markets similar to the operations of Hindenburg Research. 1. Enron Corporation 2001. Enron was once one of the largest energy companies in the United States, but it became infamous for one of the biggest accounting frauds in history. The company employed complex financial structures and accounting loopholes to hide debt and inflate profits, misleading investors and analysts. Short sellers including Jim Chanos recognized the discrepancies in Enron's financial statements and bet against the company's stock. Chanos famously predicted Enron's collapse, stating that its accounting was a house of cards. When Enron's fraudulent practices were finally exposed, the stock plummeted from a high of around $90 to less than $1, leading to bankruptcy and significant losses for investors. The case led to widespread regulatory reforms, including the Sarbanes-Oxley Act, aimed at enhancing corporate governance and accountability. 2. Lehman Brothers 2008. Lehman Brothers, a global financial services firm, played a significant role in the 2008 financial crisis. The firm was heavily involved in subprime mortgage securities, which were poorly rated and highly risky. As the housing market began to decline, short sellers targeted Lehman Brothers, betting against its stock due to rising concerns over its financial health. Notably, David Einhorn, a hedge fund manager, publicly questioned Lehman's accounting practices and valuation of its assets. The firm struggled to maintain investor confidence, and ultimately, when it filed for bankruptcy on September 15, 2008, it marked the largest bankruptcy in U.S. history. This event triggered a global financial crisis, leading to massive economic repercussions and prompting government bailouts of other financial institutions. 3. Volkswagen AG 2015. In 2015, Volkswagen was embroiled in a scandal involving the manipulation of emissions tests for diesel vehicles. The company admitted to installing software in vehicles that enabled them to pass emissions tests while actually emitting far more pollutants than allowed. This revelation was initially uncovered by researchers and subsequently reinforced by short sellers who suspected that Volkswagen's reported emissions figures were too good to be true. The impact was immediate and severe. Volkswagen's stock price fell dramatically, wiping out billions in market capitalization. The scandal led to legal actions, fines, and a loss of reputation for the company, highlighting the potential for short sellers to uncover corporate wrongdoing before it becomes widely recognized by the market. These cases illustrate how short-selling firms and their investigative efforts can play a crucial role in exposing corporate fraud and financial misconduct, similar to the mission of Hindenburg Research today.
Future outlook for Hindenburg Research and the short-selling industry.
Hindenburg Research has established itself as a prominent player in the landscape of financial investigations in short-selling since its inception in 2017. Its unique approach, which combines forensic analysis with a commitment to market transparency, has not only led to significant revelations about corporate misconduct but has also shaped the future of short-selling as a practice.
Looking ahead, several trends and predictions can be made regarding the future of Hindenburg Research and the broader implications for the financial sector. Increased regulatory scrutiny. As Hindenburg Research amplifies its investigative efforts, we can expect an increase in regulatory scrutiny of its practices and methodologies. Regulatory bodies like the SEC are likely to monitor the impact of Hindenburg's reports on stock prices more closely, particularly given the firm's ability to drive significant market movements. This could lead to more stringent regulations surrounding short-selling practices and the dissemination of negative information as authorities seek to protect market integrity and prevent potential abuses. Growth in the importance of corporate governance.
The activities of Hindenburg Research will likely foster a heightened focus on corporate governance and ethical practices among publicly traded companies. As more companies become aware of the potential for exposure by investigative firms, there may be a shift towards greater transparency in financial reporting, compliance practices, and overall corporate behavior. Companies that prioritize ethical conduct may find themselves at a competitive advantage, attracting investors who are increasingly vigilant about corporate responsibility. The rise of whistleblower culture. Hindenburg Research's reliance on whistleblower tips to uncover corporate fraud may encourage a broader culture of whistleblowing across industries. As the firm continues to successfully expose wrongdoing, more individuals may feel empowered to come forward with information about unethical practices within their organizations. This could lead to a more proactive approach to corporate accountability, with companies implementing stronger protections for whistleblowers and fostering environments where ethical concerns can be raised without fear of retaliation.
Expansion into new markets and sectors.
While Hindenburg has primarily focused on companies in sectors like technology, healthcare, and renewable energy, its methodology could be applied to a broader range of industries,
including finance, real estate, and even emerging markets. As global markets evolve, Hindenburg may expand its investigative efforts internationally, targeting companies in regions with less regulatory oversight. This expansion could lead to more significant disruptions in markets worldwide as the firm brings greater attention to corporate malfeasance on a global scale. Technological advancements in research. The future of Hindenburg Research will likely be influenced by advancements in technology and data analytics.
The firm may increasingly leverage artificial intelligence and machine learning to enhance its investigative capabilities, allowing for more efficient data processing and analysis. This could improve the accuracy and depth of its reports, further solidifying Hindenburg's reputation as a leader in forensic financial research. Evolving investor sentiment. Investor sentiment towards short-selling firms like Hindenburg Research may continue to evolve. While some investors view short-selling as a necessary mechanism for market correction, others may perceive it as harmful to companies and potentially manipulative. As Hindenburg's investigations yield more high-profile results, investor perceptions could shift, leading to a greater acceptance of short-selling as a legitimate tool for protecting the integrity of the financial markets.
Legal challenges and defenses.
As Hindenburg Research continues its work, it is likely to face increased legal challenges from companies it targets. These firms may seek to contest the validity of Hindenburg's reports, arguing that the firm's actions negatively impact their stock prices. However, Hindenburg has demonstrated resilience in defending its findings, and future legal battles could further clarify the boundaries of investigative reporting and short-selling in financial markets.
Conclusion. The future of Hindenburg Research and the short-selling landscape appears poised for continued evolution.
As the firm enhances its investigative practices and responds to regulatory pressures, It will play a crucial role in shaping corporate governance, investor behavior, and market integrity. While challenges lie ahead, including potential legal battles and increased scrutiny, the importance of transparency and accountability in the corporate world will likely remain at the forefront of Hindenburg's mission. Through its commitment to uncovering fraud and promoting ethical practices, Hindenburg Research may well catalyze significant changes in how companies operate and how investors perceive risk in the financial markets.